William Bao Bean. We're going to learn things about law from somebody who's invested with Orbit a total of about $125 million in assets under management, correct?
Yep.
Uh, at least, how many companies so far? You've seen pitches from 10,000.
Yeah,
Possibly.
well, we
That's
don't really count it. We don't bother. It's a
Yeah.
vanity metric. Like how
Yeah.
many people you talk to is
Right.
not a measure of success.
But you've actually deployed, you've invested into how many?
I've invested in 500 companies. I started angel investing in 1999, when I switched to VC in 2007, that's when really things kicked up. But before I started VC, I did 39 investments on my own. So I practiced with my own money before I started investing other people's money, and that was key learning. So about 4 or 5 companies every year for about 8 years, 39 investments. And I learned from that. It's all about tuition, and I paid my tuition with my own money before I took that learning and started investing other people's money.
So we're about to hear some wisdom from somebody who's invested a lot of money in a lot of places, mostly. You were a stock picker back in the golden days of Chinese growth.
Yeah. So I started off in equity research, first in Asia, then in the U.S. So we covered, Apple, Dell, HP, IBM, and then switched out back to Asia in 2002, and I covered China tech media and telecom. When I started covering that space, the total value of all the tech companies in China was 1.5 billion. When I stopped investing in China in 2018, it's 3.5 trillion. So there was a tech-driven economic transformation that drove China. That was from 2003, 2004, 2005. Started investing in India, and then we kind of kept on moving west. We diversified out of China from 2015 because it did its thing, and we stopped investing from 2018. At that time, there was 60 billion US dollars a year being deployed in China, 5 times Europe combined. So they didn't really need our help anymore. And the other thing is we help with cross-border. We help companies grow up in the home country, go cross-border. None of the Chinese were interested in going out of China because the China opportunity was so much greater than anywhere else in the world. And the other thing is that international companies selling into China discovered that a lot of Chinese companies don't pay for tech. So we were helping our companies sell to multinationals in China. And then those companies started to support, P&G and Unilever and HSBC in other markets around the world. And we followed our portfolio companies out of China. So one of the things that's very important is to make sure that you make change, look at the data, follow the data. You might say, okay, I think that China is a huge opportunity. But the key thing is what happens when you try and go into a market. What does the data tell you? And the data told us that China wasn't really a opportunity anymore in 16, 17, 18. So we got out.
And let's recap. You're in other parts of Southeast Asia now.
Yeah, so we expanded from 2015 Southeast Asia, and mostly Malaysia, Philippines, Vietnam. We did some exploratory investments in Indonesia, but did not dedicate too much capital there. We went very heavy 2015, 16, 17 into India. We thought that India was prime for this leapfrog effect. And now, 24, 25, 26, we've actually seen India get tons of unicorns. That market has really taken off. We started investing less in India 3 or 4 years ago because India had that trajectory. We started to go into South Asia, Pakistan, Bangladesh, where again, we see the opportunity that we saw in China, then India, and these other large markets. And 2021 is a little bit delayed, but we started to go into Africa, the big markets like Egypt, Nigeria, Kenya, Morocco. We don't do that much in South Africa. And in 2023, when the Americans pulled out, we doubled down on Latin America.
The Americans pulled out.
Yeah, the Americans pulled out of everywhere, but they had gone down and they were like, oh, wow, Latin America's cheap. So we'll pay much lower prices in America, but much higher prices than any other emerging market in the world. So there's a mispricing driven by American VC investors. And when they pulled out, there was a repricing downward, more in line with other markets around the world. And we're taking advantage of that to fill that gap.
We should define something for anybody watching this who is not already familiar with the world of VCs and investing, you basically collect money from people that would like to get a great return but are willing to tolerate a lot of risk, right?
Yeah.
And then well, why don't you put it in your own words?
Yeah. So if you think about where you're going to put your money, there's bonds, savings accounts, stocks, ETFs are very very popular, and then there's real estate. Then within private side, there's private equity, there is growth, and then there's venture capital. And people look at venture capital as the riskiest because you're investing at very early stages. There's not a lot of history. There's not a lot of financials. They're generally not profitable. But the thing is, like in 8 out of the last 10 years, venture capital has outperformed every single other asset class in the world. Now, the
Including
challenge,
Bitcoin.
that's not an asset class. Yeah. The now the important thing to note here is that there is a distribution in returns among VCs. Not all VCs are created equal. In fact, half the VCs don't even return money. So it's kind of important to be able to get into the better VCs. And a lot of the big VCs that you've heard of, A16Z, they're pretty hard to get into, or say a Sequoia. So there's a focus on emerging managers. So young managers, when I say young, not young in terms of age, but young in terms of experience, who have great networks. For us, we've been doing this a very long time, but we've been doing it a very long time at Orbit in emerging and growth markets, which is a different type of specialty. So we take risk. But the key thing is we have a lifetime support program where we work very hard to take the risk out. And we do that in two ways. The first way is we help our companies get sales. If you don't have sales, then if you can't get capital, you don't die because you have sales to back, to fall back on. The second thing is that there's a huge amount of volatility in emerging markets. So at any one time, there's like countries going up and there's countries going down. So we help our companies expand cross-border into multiple countries. So because all the countries in a region or all the countries in emerging markets around the world don't all go down at the same time. So that's how we take a lot of the risk out. And because of this, we have power law just like any typical US VC, where there's companies that do not perform and you're making most of your money in like one company out of 10 or 1 out of 15. But because of our ecosystem approach, where we help with sales, where we help with cross-border expansion, where we help companies get to that positive unit economics, what we're doing is we're pushing up the middle. So our companies have a better survival rate, and we and the founders that we partner with are making money on more. So instead of 1 out of 10, it's 2 out of 10, 3 out of 10. Our goal is 4 out of 10.
Let's talk about law. What have you learned about law in these growth markets? Anything related to contracts, IP, business formation?
Yeah, so you go back in time. IP was a difficult one because if you tried to patent something, your competitors would use that as a roadmap to copy and reverse engineer what you're doing. So you wouldn't patent the important stuff. You wouldn't patent everything around it, and hopefully they wouldn't figure out what your secret sauce was. So we do encourage some of our companies to patent. There's the U.S. framework, the European framework, the global framework. A lot of times it's really about just running fast. If you can run faster than your neighbor, you can do well. So, there's an example of, people patenting ride sharing in the US. So 40% of Uber and Lyft's revenue in the US is in violation of a patent portfolio. But how do you actually extract value out of it? Who's making more money, the person who patented it or the person who actually delivers the ride platforms? It's the people who deliver the ride platforms. So we're less focused on patenting and more focused on execution.
All right. What about contracts?
Yeah, so contracts, it depends on which market you're in. But the question is not so much the contract, it's the enforceability. So usually what we try and do is encourage people to sign contracts. But the contract should be hopefully a win-win-win. If the contract is too unbalanced, the contract's going to get violated. And usually in most markets, there's not that much you can do about it. Lawsuits are expensive. For us, lawsuits should generally be avoided if possible. Now, sometimes there's lawsuits just to prove a point, but there's usually no winner in a lawsuit. So what we try and do is focus on helping our company sign contracts where at the end of the day, you never have to read that contract again. because people are happy with the actual business result.
That's good wisdom. Right. If you look at the contract, something's already wrong.
Yep.
All right, we're in the age of AI, or at least the beginning of it, depending on who you believe here. AI is ubiquitous at this event this year, 2026 in VivaTech. What do you think? Overhyped? Do you see it used in these growth markets among your startups? Anything
Yeah,
you want to say? Oh, and is it governable, or is it fundamentally something that cannot be governed?
yeah. So I think one of the things that most people miss is that when we started off in China, 2010, China is very, very, very competitive. And any type of edge people would use. So I think TechCrunch named us in our consortium number three most active VC investor in the world in AI back in 2018. It was because that if you were not leveraging algorithms and then machine learning and then I guess now AI, you were not competitive. Now the difference is that there's AI for developed markets where people can afford tokens, and then there's AI for emerging growth markets. And so for our companies, they're definitely leveraging AI, but it's very different than you see in the US and now China, where the AI is becoming the product. The AI drives the product, but oftentimes the end users, whether it be a consumer or an SME or an enterprise, are not in that and directly working with the AI agents. They're actually working with the product. So if you think about SaaS has never been a thing in emerging markets because people don't have $30 per person per seat a month to pay. And it's too expensive. So what we're seeing is a massive revolution. It's driven by AI because the cost of delivering SaaS has gone down. Developing SaaS and delivering SaaS has gone down to almost zero.
We should clarify software as a service.
Software as a service where you pay for the software. So our
The
companies,
classic example of for any consumer would recognize a YouTube subscription for YouTube Premium. Is that software as a
that's
service?
that's more like a service model.
So it's more businesses paying for a service like
Yeah,
an
but I mean, I
enterprise,
don't know. Like you can think about you're an enterprise, but
right?
you got a Spotify account, so you're paying every month for something or a YouTube subscription, sure.
Or a
But this
company
is
paying for Microsoft for a license for its
yeah,
employees.
Microsoft. It's a software. You're not
Right.
buying a physical box,
Got it.
plugging it in, and you own it. You're paying monthly as opposed to one time.
And that's why a lot of investors love it. It's a beautiful business.
Yeah, it's a
If
recurring revenue. The
exactly.
thing is, nobody's ever actually used that model in an emerging market. So what our models are driven around giving the software away for free and then making money in other ways, like financial services, like providing credit. So those what's changed with AI is the cost of developing the software. The cost of developing software that you can give away for free has gone down significantly. Whereas if you're in the US or in China, you can blow money on tokens because the customers have enough money to pay you for the compute. In emerging markets, that simply does not exist. And in many markets, the compute is not even available. So our companies are developing software, they're giving it away, they're making money other ways. And through our ecosystem, if one of our companies sends a user or a customer to another company, that other company makes money on that user, they give profit share back. So lowering the cost of developing software and then lowering the cost of customer acquisition. This is the emerging markets or growth markets approach that Orbit takes in order to drive profitable returns for our investors. It's a win for the founders, it's a win for the customers, and it's a win for Orbit and our investors.
All right. We got one last topic to cover, and then I think we will have covered a lot.
Yeah.
All right.